Been a financial advisor since 1992, and over the years, I've helped countless people navigate the complex world of investing. Now, today, I want to talk to you about three significant money mistakes to avoid, and specifically for those of you that were born between 1981 and 1996. Yes, I'm talking to the millennials. Now, before we dive in, just a quick reminder, the advice in this video is purely educational, should not be considered personalized financial advice. First up, savings. I know things aren't easy. Higher cost of living, soaring housing price, increased interest rates, and the long list of financial responsibilities you already have. So you might be thinking, where am I supposed to find the money to save? And trust me, I get it. I've been there. But here's the hard truth. If you can't find the funds to save now while you're working and earning an income, how are you going to survive when you stop working and you have to rely on your investments? You'll be working forever. And it may sound harsh, but it's true. Now, the good news, it's okay to start small, create the savings habit, and then increase that on a regular basis. So, for example, let's talk about your 401k. Every year that you delay contributing, you're losing out on valuable time, and that time can never be recovered. Let's look at two scenarios. Scenario one, employee A, they start contributing to their 401k at age 30, and they stop at age 40. Scenario two, employee B starts contributing at age 40, and they continue until they're age 67. Now, here's how that played out. With a 10.2 annual return, the historical average for the S&P 500, $500 a month for each employee. Employee A, they contributed for 10 years, and they had $1.6 million at age 67. Employee B, who contributed for 27 years, would have just under $920,000. Now, that's a massive difference. And the reason that I'm talking to you about this now, it takes 30 years or more to fund an adequate retirement plan. Next up, let's talk about debt. For most of us, housing and transportation are our two biggest monthly expenses. And the average mortgage today is $322,000 with a monthly payment around $2,100. The average price of a new car is just under $50,000, and you're looking at $870 a month for a 72-month payment plan. It's almost $3,000 a month just on two expenditures. Now, here's the thing. If you go into retirement and you still have a mortgage, you have car loans, it's either going to delay your retirement plans or it's going to eat substantially into your disposable income. So what can you do about it? Go online, find a loan payoff calculator, and figure out how much money that you need to pay each month to have the mortgage paid off when you reach retirement age. It's vital that you tackle these debts early so that you can be financially free when you retire. Now, finally, let's talk a little bit about protection, specifically insurance. Most people only focus on the cost, thinking that all insurance is the same. But the truth is, not only is insurance not created equally, but you want to make sure the insurance company that you pick has a strong reputation for paying claims so that you're covered when you need it most. And for anyone that has those others that are dependent on your income, like a spouse and or your children, you're going to need to have life insurance. Now, I've found that most people don't realize how to calculate accurate life insurance needs. And if you earn $75,000 a year and you have a $250,000 life insurance policy, that's not going to be enough. And so, for example, with a net income of $65,000, $250,000 is going to replace just 3.5 years of income. At $500,000, would cover about 8 years of income. In a $750,000 term policy, it's going to cover about 11.5 years of income needs. Now, to provide peace of mind, the insurance should also cover the balance due on your mortgage for your survivors. Now, I know this sounds like a lot to take in, especially if you're already spending more than you make, if you've built a lifestyle based on credit cards. But the truth is, if that's you, you're going to have to make some hard choices because at some point it will catch up with you. And it usually happens at the absolute worst time possible. Now, to be financially successful, You need to live within your means. And yes, you're probably going to need to cut back on some non-essential spending. Is it easy? It's not. Is it vital for your future? Absolutely yes. Now, I hope this video is giving you a clear understanding of the importance of savings, debt reduction, and having the right protection. I want you to stay tuned for more insight, and don't hesitate to reach out to a financial advisor to make sure that you're on the right path. I want to thank you for watching today. I hope that you found this helpful. Be sure to comment, subscribe for more financial tips in the future. We'll see you in the next video, and have a great day.